Welcome to the What to Watch video update. Every week I do a number of different videos. I do a video each day. I do a weekly video. Every week I do an intermarket analysis video. I do a deep dive video where I go through and talk about charts that I really didn't discuss in any of the videos. And then the very last video that I do that's turning into a weekly video, but I like the idea that this can be updated on an as needed basis, although I haven't been doing that lately. This is called the What to Watch video. This is not the What's Going to Happen video. We look at some positive things and some negative things to kind of get an idea of some things to really watch over the upcoming week to see, are we turning back and going more positive if some of these positive things start to play out, or we've been negative now and we're shifting over negative. Are we going to turn even more negative? Now, when I did this video a week ago, the market was at a very interesting place. We saw a whole lot of things coming together all at the same time. And if ever the market was going to find a level of support and bounce up, we saw it a week ago. We broke through that level, and things have turned decidedly negative since then. We still may have further to go to the downside, but nonetheless, there are some positive things that we can look at, and there's some negative things that we have to respect and pay attention to. This is being prepared for Monday, April 22nd. The first thing is I go through and list the different positive things. Now, I've been talking about this for a while. The markets are anticipating that rate cuts will be slow. Earlier in 2024, this scenario had been developed and then pretty much confirmed by the Fed. And then even Chairperson Powell on Good Friday actually gave a speech that kind of fed into that, okay, maybe the Fed will come in and be able to cut rates, and we can do it because of what's going on in the U.S. economy. However, since that time, we've been seeing stronger than expected economic reports. There's renewed geopolitical tensions in the Middle East, and we're seeing a market that was really overextended to the upside that now has been pulling back. And this whole buy the dip idea just has not been working for folks. As that's been falling apart and we've been falling down more and more, we're switching over more to a negative environment as this whole scenario is now in doubt. But in the long term, the S&P is still in an uptrend. There are some internal indicators that we look at, studies that we do on the S&P 500, and some advanced decline line studies, not only on the S&P, but some other indexes that are giving us some signs of hope. May not be a lot to hang on to right now, but we're seeing these things starting to develop, and we're seeing it across a number of different indicators. We also do a 20, 50, 100, and 200 period moving average study of the S&P. These are stocks inside the S&P 500, not just the S&P itself, but what are the stocks inside doing? And we're showing a little bit of improvement with these studies. For right now, the 100 period moving averages, both the exponential and simple moving average, they're holding for the time being. We came down and fell below the 20. That turned to short-term negative. Now we've fallen below the 50. That's really shifted the intermediate term over to negative. The kind of long intermediate to long-term moving average that we focus on is now the 100 period moving average. If we break below that, the next moving average that I mainly focus on is the 200 period moving average, and that's pretty significant. Right now, we're still above the 100 period moving averages. Are we going to come down a little bit and maybe test that as support? Will we even come down to that level? What's going to happen if we end up closing below it and break this level as well? That could be a suggestion that things are turning more negative. But for right now, price is still above that moving average. We have high leverage loans, which are still holding up. A lot of the other markets have been falling apart. The ETF that we follow for this, yeah, it's coming down close to its 50-day moving average, but it didn't see a significant decline this past week. The financials, they were weak a week ago when bank earnings started to come out. Now they're showing some signs of improvement. And then we look at some very long-term support. Going back like to the 1987 crash up till now, we're still above a very, very long-term upward sloping trend line. Some of the ratios that we look at when we look inside the QQQs or the NASDAQ 100, they're holding for right now. There's another one that's showing a little bit of weakness. And then there's a thing called the Zwag NYSE Breadth Thrust. This was developed by Marty Zwag decades ago. It's one of the very first books that I read back in the early to mid 90s. And he did a lot of research and came up with this idea that when we get really negative and then immediately shoot up and become positive, that can be very good for the market. Over the last year to 13 to 14 months, we've seen 2 of these WAG NYSE breadth thrusts triggered, and that's been quite positive for the market. Now, it's not happening yet, but there's a setup for the possibility of this to actually unfold, and I'll show you that chart. So here is the chart that I've been going through quite a bit. If the Fed is able to cut rates because of what's going on in the economy, that's more of a slow cycle, and that tends to be more beneficial for stocks rather than if something really drastic is happening that's negative, like an event or the economy is just falling off a cliff or the great financial crisis or something like that. When the Fed has to cut rates for those reasons, that ends up being negative for stocks, and there's some logic that applies there. Then we look internally at the S&P 500. One thing that we look at is the advanced decline ratio. The blue line is based on 19 periods. The red line is based on 39 periods. And even though we're below zero and have been declining, we're starting to turn back up. So this is one potentially positive thing. And you're going to see this in a lot of the charts, including this one. The advanced decline line based on price and volume, yeah, they've been going down, but you can see how they're starting to turn back up, even though the S&P has been declining. We also look at the new highs, new lows. Now, this is declining when we look at the 5-period moving average and the 10-period moving average, but that's mainly because the new highs have been contracting. We're not seeing a real big expansion of the new lows here, even though we've been falling with the S&P. That's positive in and of itself. So this, for right now, has been holding up and is more of an internal measure that we look at. We also look at a 20, 50, and 200-period exponential moving average. As the S&P has been going down, this became extreme negative on the 20, but is now starting to turn back up. We're also turning up with the 50 and showing signs of life with the 200. This is the McClellan oscillator. This is short to intermediate term, where we had gone extreme negative. Even though the S&P is coming down, this is starting to bounce back up. Then we look at a cumulative study for the S&P 500. The top area is based on price. The bottom one is based on volume, and we're ticking up slightly. Not a lot of positive here, but at least we're turning up where the index has been going down. Then we look at those stocks that are above their 20-period moving averages. We got extreme negative, and now we're starting to come back up. So we're seeing some signs of improvement in the short term. We're also seeing it turn back up with the 50-period moving average study, a little bit with the 100-period moving average study, and even a little bit with the 200-period moving average study. So this could suggest there's some strength inside of the S&P. Now, it may not see any follow-through. This could fall apart. All of these things could fall apart really easily. We're just latching on to some potentially positive things that we're seeing right now that we want to keep an eye on. Here's the 100-period moving averages. I have a simple and an exponential moving average. We're just a little bit above that right now. Is this going to end up providing some kind of support? Then we look at outside of the S&P 500, the NYSE, to get a broad market measure. This is a cumulative advanced decline line right here where we're starting to go back up. We're turning up a little bit with the other regular advanced decline line for the NYSE. This is a different advanced decline line, calculated slightly differently. It's also starting to turn up after seeing some weakness. Then we look at common stock based on price, starting to turn up. Common stock based on volume, starting to turn up with this advanced decline line study. The NYSE McClellan oscillator had become extreme negative and is now starting to bounce back up slightly. These are the high leverage loans. Everything else fell apart this past week. Nah, we're still above the shorter term moving average here. When we look at this ETF of very risky loans, and if you think the people that owned this ETF were starting to freak out, you'd think they'd come in and start selling and we would see this price drop. We haven't seen that. So for right now, this is holding up. Now, there's other times when this thing just got hammered. Back in 2022, it was a very difficult time for this ETF. Of course, the COVID plunge was difficult for everything. But since we crossed over and became positive, this has really showed some strength that we don't see in other areas of the market. And this is a pretty risky area of the market itself. Financial sector, it's about the only main sector or index that I've been following that is even making an attempt at coming back up to its 50-day moving average. We did fall down below it. We're still right at the 50-day moving average, but this is showing at least signs of improvement. Then we do a ratio between the financial sector and the S&P, where we have been in an uptrend, but it really broke out in Friday's session. It's actually going a little bit above this previous range that we've been in. That could potentially be positive. And here's a very long-term chart going back to 1987, and then we have a trend line going forward. Even though we've been declining, we're still above this very long-term trend line. This is a blow up just going back to 2018 of that same chart going back to 1987, showing how we're still above this long-term trend line. Then we look at a ratio between the NASDAQ 100 and the Dow. Yeah, we're coming down a little bit here. We're not as strong as we were a week ago, but we're not falling off a cliff yet either. Now, this is a long-term chart, and it's also a weekly chart, and it can take some time for this to develop. So yeah, we're a little bit concerned about this, but it isn't really showing a lot of weakness, at least to this point. This is a similar study. This is actually going up. When you look at the QQQs and compare it to the small caps, this ratio is right back about where we were at some very high readings. And this is the ZWAG NYSE breadth thrust. When we get a very low reading and then immediately shoot up out of that, that's the breadth thrust that he found. We saw one last March in 2023, not 2024. Now that one pretty much has fallen off the books. According to the research that I've done, these last about a year. Well, then last October, we saw another one where we were getting an extreme negative reading and we immediately shot up. And that's another NYSE breadth thrust that we're seeing. Now, we're not seeing a breadth thrust here, but we're seeing a possible setup for one. This is the first time since last October that we're seeing this indicator getting very strongly negative. If we have a really solid up day, we're going to be waiting to see if a new breadth thrust is actually generated. We don't know. It's pure speculation at this point. We're just watching this for right now. Then I look at the negative things, and man, the list is long. If you watched this video a week ago, the positive list was pretty long. Well, since we broke all those convergence areas and we really had a down week, everything that was on the positive list is now on the negative list. And so I've tried to kind of shorten it up and organize it a little bit. Sentiment is still falling after being extreme positive. We had become quite complacent in the market. Everyone just assumed it was just going to keep going up and up and up. Anytime we saw a smidge of weakness, people were buying into that because they do this buy the dip thing. Well, it's kind of changing tunes now as things are turning more negative. The point and figure chart, where it had been extreme positive, now we're seeing some circles drawn and it's starting to look a little more negative. There are multiple convergences that we were focused on a week ago. They all failed simultaneously. And these include those things that we were watching in the short term, intermediate term, and long term on the S&P 500, and then numerous S&P 500 indicators that we follow that were already negative. Well, our list is even longer now. We have the S&P and NASDAQ 100 bullish percent indexes. Those are pretty key. We also have the NYSE bullish percent index. Now it's still positive, but it's weakening. The parabolic SAR weekly chart. If I was to take out one thing that I talked about a week ago that gave me the biggest red flag warning sign, it was we just saw the weekly chart turn negative after we had already seen the daily chart turn negative. This was kind of a big deal. And so that's why I wanted to point it out in last week's video. Well, it's even more negative now with another dot on top. The accumulation, distribution, and chicken money flow. These are indicators based on volume. They're also supposed to be smart money indicators, and they're continuing to look more negative. Then a lot of indexes broke support. This includes the Dow, the S&P, the NASDAQ 100, large cap growth, the mega caps, the NYSE, the Wilshire 5000, the total stock ETF, the FANG index, the tech sector, stocks. These are the major things that we were watching a week ago, wondering if this was going to hold up. Well, it didn't hold up. And so now we broke through some things that we were watching there. Growth to value as well as discretionary to staples, those ratios are weakening. Growth is really getting hit hard right now. And the VIX is starting to go up. This is a fear gauge. When the VIX is low, it's time to go. Well, that's actually when you see the best returns for the S&P across the market. Now the VIX has really been climbing. That means there's a lot of hedging that's going on. And so when that goes up, that means that we're typically going down with stocks. Then risk on ratios are showing weakness. Risk on means people are buying stocks. Risk off means they're either out of stocks or actually getting into bonds. And we're seeing some risk off ratos there. That's a misspelling there. They're showing a little bit of strength. Now, this was mainly in Friday's session. We don't know if this is an anomaly or if this is the beginning of something. We just want to keep an eye on this. Oil may continue to climb. There was an attack a week ago in the Middle East where Iran attacked Israel. Then before Friday's session, Israel went back and attacked Iran. And that was more limited, and it appears to be at least at an okay place for right now. Oil has been coming back down a little bit. We see more tensions in that area. Oil could shoot up really quick. And then the US dollar is still continuing to be rather strong, and that usually puts pressure on stocks. Here is the fear and greed index, where we were up here above 75. Everyone's happy. Everything's fine. Getting a little complacent, just assuming that the market was going to continue to go up. Then we started to drop. Now, when we're getting a really high reading, we entertain the thought of using this as a contrarian indicator. Everybody's happy. We want to look for some negativity. Then once we started to break, now we go with it. So this is going lower as sentiment is more negative. Now, if we drop down below 25, then we're going to get extreme negative, and that's when we entertain the idea of becoming positive again. We don't know if we're going to even get down to 25, and if we get down there, we don't know how long it's going to stay, and it can even go lower than 25. We just want to keep an eye on this. Here's the point and figure chart. When I showed you this a week ago, we saw nothing but solid up X's. Well, with the declines over the past week, now we're seeing some O's that are being drawn in here. So this is showing some weakness. Here's the 20-period simple and exponential moving average. We lost that. We closed down below it. We actually lost that a week ago. But this is actually turning more negative in the short term. Here's the 50-period moving averages. We were wondering, can it hold up here? No, it didn't. We fell down below it, and we're turning more negative with this moving average study. And then here's another moving average study based on 50 periods, a double and triple exponential moving average. I mainly follow the red and the blue line. When the red line falls below the blue line, that moves faster. That means there's more intensity to the downside. And you can see all this red on the chart. It's not really hard to figure that out, that we're going down pretty fierce right now, maybe a little too fierce. This is the long-term chart that for months I've been focusing on, and we were wondering if this R1 level, which was around 51.10, if that was going to hold. Well, not really. We ended up closing at 49.67 on Friday. So no, we came down and fell below this. It put up a bit of a good fight there for a while, but we ended up dropping down below that. That's long-term support that has not held. But the long-term trend, there's a positive side to this chart where the blue line's still above the red line. That's positive. The negative side is we're dropping below the blue line. So this is a 13-week moving average, and we're showing weakness there. Also, this is another weekly chart where we're dropping down below this 10-week moving average here. This is one level of support that we thought we closed right on it a week ago. No, didn't hold. We're breaking down. Now we may come down and actually test the previous all-time high. That may act as some kind of support if the 100-period moving averages don't hold. Bullish percent index, and this is an indicator that I really like. It's not moving average based. This measures the point and figure buy or sell signals inside of the S&P 500. We were looking extreme positive. Then we drop below 70. That's a sell signal. Get out of your long positions. We continue to decline, and now we're dropping below 50. So now this is actually turning negative. Accumulation distribution. We are going down, and we're below the moving average, and the moving average is starting to roll over. This is supposed to be a smart money indicator, and it's showing weakness right now. Also with the check and money flow, we're really looking negative here. In fact, we might be looking a little too negative here. This could be an extreme negative reading when compared to what other readings we saw during other declines. And here's the parabolic SCR. This is a weekly chart. We're negative on the daily chart with a whole bunch of dots on top. This is the second week now that we see dots on top here. That is longer term negative. The NYC bullish percent index, it's declining, but it's still above 50. So there's a negative side and then it's declining. There's a positive side that it's still above 50. The NASDAQ 100 bullish percent index, my goodness, this is getting extreme negative and very negative at the current time. I have a chart here that I just made this up before I started this video. This is showing a real extreme negative reading, and this goes back 20 years to show, okay, these are other times when we saw extreme negative readings. We might find some support in here. We might see some buying coming back into the NASDAQ 100, but then again, we could also see some more weakness after this. Here's the long-term chart of the large cap growth where we fell down below the 50 period moving average. Now we're coming down to the 100 period moving average. That's the negative side. The positive side is the 100 is holding for right now, and all of the lines are still going up. That's also positive. Are we going to find some support in here and be able to bounce up off of that, or are we going to continue to go down to the 200-day moving average? Mega caps. This is what really led the market higher. Now we're seeing a pullback. Still in a longer-term uptrend, but seeing some real recent weakness. The Wilshire, a broad market measure, fell below the 50-day moving average and is continuing to decline, although it was up in Friday's session. This is the total U.S. stock ETF. It's still in a longer-term uptrend, but now it's falling below its 50-day moving average. The FANG index, Facebook, Apple, Amazon, Netflix, Google, and then NVIDIA and any of the Magnificent Seven are in this index here. This is what's really been leading the market higher. Now we fell below the 50-day moving average. We're still in a longer-term uptrend, but we have been seeing some weakness. The tech sector, another really strong area. This has been a real darling for folks. Well, it's pulling back below its 50-day moving average. It actually closed a little bit below this a week ago, and it just continued to show more weakness this past week. Then we look at the semiconductors. If you can't quite see this because these moving averages don't go back that far. In October of 2022, this was the first golden cross that we saw when things started to get better. Well, that's really what's been leading the market higher. Now we're seeing some weakness. We're still in an uptrend, but dropping down below this 50-period moving average is kind of scary and not real positive right now. Wondering if we're going to come all the way down to the 200-period moving average study. The QQQs, this is also a little bit scary. We see the 20-period moving average. We're in danger of seeing a death cross here where it may cross below the 50-period moving average. So this is positive for right now, but any more weakness, and the longer we stay below both of these lines, the more likely we're going to see a death cross with those moving averages. The NASDAQ also broke support, but is still in an uptrend. NASDAQ 100 broke support, still in an uptrend. And we're seeing a real shift now when we look at large cap growth versus large cap value. The blue line had been on top. Even when we were going down, the blue line was on top. Well, after Friday, the red line is now on top. Even though these are on different scales, value is now starting to outperform growth. And here's an intraday growth to value ratio for the S&P. It just fell off a cliff this past week. We look at small cap growth to value. Had been looking better, showing some real weakness now. Mid cap growth also showing some weakness. S&P growth to value on an end of day basis, showing some weakness here. And we look at some ETFs. The growth to value ratio had been more or less positive. Now we're coming all the way down to this 250 period moving average. Are we going to be able to bounce up off of that? Or are we going to slice through this whole rainbow and then stay below this and then see these lines start to roll over? That's what we're waiting to see. And it's going to take some time for this to play out. And we look at discretionary versus staples. We're seeing weakness here where discretionary has been underperforming. We're looking at the VIX really starting to go up. I chart a line chart up here in the middle area. That's the closing value. And then I also chart a bar chart here where we actually crossed above 30 for a period of time. Is that right? Or was it 40? Or was it 20? Okay. We saw a really high reading here. We ended up closing down off of that, but there was an awful lot of movement in the VIX in Friday's session. And the fact that it's going up is negative for stocks. And this is the VIX of the VIX. This is an indicator to see how fast the VIX is actually moving. When it's really moving around, we see this going up, both with the bar chart and with the line chart. And then we're looking at staples, the things that are more defensive, the things that you have to have no matter what's going on in the economy. And then the tech sector, which has been the real darling. For ever since we started to bounce up in 2023, this ratio has been going down, meaning that the tech sector has been outperforming staples. Well, look at how it really spiked up in Friday's session. Now, is this the beginning of something? Or is this just something that's more of an anomaly and this will get worked off and we'll start seeing this ratio going back down, meaning that staples will go back to underperforming the tech sector? Another thing we want to watch. Then we're looking at a number of different ratios. This is the tech sector compared to bonds, where they had been showing that the tech sector was outperforming. Now we're seeing a pullback. The broad market had been outperforming 3 to 7 year bonds, seeing a pullback. We're really going up here when we look at 1 to 3 month treasury bonds and compare them with 3 to 7 year treasury bonds. When this is going up, that means there's interest rate concerns or fears. And we're seeing that right now. The market is also thinking that we're going to have a soft landing, that we're coming out of some rough economic times without going into a recession. When this is going up the way it has been, that's what the market is pretty much anticipating. We're seeing that a little bit in doubt right now. So we're going to be watching this. A hard landing is when we do go into a recession. We look at the QQQs and compare it with bonds. The Qs have been really outperforming, now starting to come back into the rainbow. TIPS, which are short-term, these are Treasury inflation protected securities. When the TIPS outperform 7 to 10 year bonds, this ratio goes up because that means interest rates are going up and these are shorter term and you can mature them and roll them over into a higher interest or higher yield. When this is going down, that means folks are trying to lock in longer rates, 7 to 10 years, because they want that higher rate for longer. Well, we're really starting to go back up with this ratio now, as inflation worries and interest rate concerns are starting to come back into the market. Home construction, another very interest rate sensitive area, had been performing really well. Now seeing a bit of a pullback here. And then this is staples to S&P. When this ratio is going down, the S&P tends to go up. Look at how we spiked up in Friday's session. Again, is this a one-day wonder kind of a thing? We don't see this big of a move that often. So we're wondering, is this going to calm down a little bit, or is this the beginning of something? Then here's a long-term weekly chart of the NASDAQ 100. Going back to 2009, we have closed below this trend line now. So that's negative in the longer term. Oil, we want to keep an eye on that. It really had been spiking up. It ended up settling down. We just want to watch the price and see what's going on in the news, especially in the Middle East. The dollar continues to be strong, even though it closed down under the 106 level. It's at the high 105s right now. The dollar going up tends to pressure stocks. Thank you. I really hope you found this helpful. If you want to get updates of what's going on, please check out the daily videos that I post every day. That's why they're called the daily video. I hope you have a very good weekend, and I will talk to you in the next video.